Welcome back to Accountant's Desk. In part 1, we covered the basics, the meaning, format, and the golden rules of debit and credit, along with one simple example. In this video, we will take it a step further. We will solve a complete practical question, recording each entry step by step, and I'll explain the logic behind every debit and credit so you truly understand how journal entries work in real life. And if you are a small business owner in need of bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Alright, let's get started. Mr. Ram furnishes the following information. Transactions during the month of April 2025 are as under 2025, April 1st, started business with cash rupees 1,50,000. 1st April, purchased goods from Manisha rupees 36,000. 1st April, purchased stationery for cash rupees 2,200. 2nd April, opened a bank account with SBI for 35,000 rupees. 2nd April, sold goods to Priya for 16,000 rupees. 3rd April, received a check of 16,000 rupees from Priya. 5th April, sold goods to Nidhi rupees 14,000. 8th April, Nidhi paid 14,000 rupees cash. 10th April, purchased goods for 20,000 rupees on credit from Ritu. 14th April, insurance paid by check 6,000 rupees. 18th April, paid rent 2,000 rupees. 20th April, goods costing rupees 1,500 given as charity. 24th April, purchased office furniture for 11,200. 29th April, cash withdrawn for household purposes rupees 5,000. 30th April, interest received cash 1,200. 30th April, cash sales 2,300. 30th April, commission paid 3,000 rupees by check. 30th April, telephone bill paid by check 2,000 rupees. 30th April, paid salary in cash 12,000 rupees. Alright, we have gone through the question. Now let's start recording each transaction in the journal step by step. Our first transaction is 1st April, started business with cash rupees 1,50,000. Here the two accounts affected are cash account and capital account. Cash account is real account and cash comes in the business, so it is debited. And capital account is personal account and owner is the giver, so it is credit. Let's see how we'll record it. Journal entries in the books of Mr. Ram, date, particulars, ledger folio, debit, credit. 2025, 1st April, cash account debit 1,50,000 rupees. To capital account 1,50,000 rupees. And the narration is being business started with cash. Next. 1st April, purchased goods from Manisha 36,000 rupees. Here the two accounts affected are purchase account and Manisha's account. Why? Because we have purchased it on credit. It is not mentioned that we have paid. So it is assumed as credit transaction. So the two accounts are purchase account and Manisha's account. Purchase account, it is nominal account and purchase is an expense, so it is debit. And Manisha's account, Manisha is person, so it is personal account. And Manisha is the giver of goods, so it is credit. Let's see how we'll record it. 1st April, purchase account debit 36,000 rupees to Manisha's account 36,000 rupees, being goods purchased on credit. Next. 1st April, purchased stationery for cash 2,200 rupees. Here the two accounts affected are stationery account and cash account because we have paid the cash. So stationery account is nominal account and we have paid for stationery. So it is expenses. Debit all expenses. So it is debit. And cash account is real account and cash goes out of the business. After purchasing stationery, cash goes out of the business. So it is credit what goes out. Let's see how we'll record it. 1st April, stationery account debit 2,200 and to cash account 2,200 on credit side. And the narration is being purchased stationery for cash. Next. 2nd April, opened bank account with SBI, rupees 35,000. Here the two accounts affected are bank account and cash account. Why? Because bank is the receiver of cash and cash goes out of the business. So Bank account is real account, and cash comes in the bank. So it is debit what comes in. And cash account is also real account, and cash goes out of the business. So it is credit. Let's see how we'll record it. 2nd April, bank account debit 35,000 rupees on debit side, to cash account on the credit side 35,000 rupees. And the narration is being opened bank account with SBI. Next. 2nd April, sold goods to Priya 16,000 rupees. Here the two accounts affected are Priya's account and sales account. Here it is not mentioned that we have received cash, so it is assumed as credit sales. The two accounts are Priya's account and sales account. Priya is person, so it is personal account, and Priya is the receiver of goods. We have sold her goods, she has received. So Priya is the receiver of goods, and debit the receiver, so it is debited. And sales account is nominal account. After sales we will get the cash. We have not received it immediately, but in future we will receive it, so it is income. So credit all incomes, so it is credited. Let's see how we'll record it. 2nd April, Priya's account debit 16,000 rupees on the debit side, to sales account credit side 16,000 rupees, and the narration is being goods sold to Priya on credit. Next. 3rd April, received check from Priya 16,000 rupees. On 2nd April, we have sold goods to Priya, and on 3rd we have received check from Priya. So the two accounts are bank account and Priya's account. It is received by check, so bank account, and Priya is the giver, so it is bank account and Priya's account. So bank account is real account, and for bank cash comes in, so debit what comes in. And Priya's account is personal account because Priya is person, and Priya is the giver, so it is credit. Let's see how we'll record it. 3rd April, bank account debit 16,000 rupees on the debit side, and to Priya's account 16,000 rupees on the credit side, and the narration is being check received from Priya. 5th April, sold goods to Nidhi 14,000 rupees. Here the two accounts affected are sales account and Nidhi's account. Nidhi is person, so it is personal account, and we have sold goods to Nidhi. So Nidhi is the receiver, so debit the receiver. And sales account is nominal account because sales is income, so it is credit. Let's see how we'll record it. 5th April, Nidhi's account debit 14,000 rupees, to sales account 14,000 rupees, and the narration is being sold goods to Nidhi on credit. Next. 8th April, received cash from Nidhi 14,000 rupees. On 5th April, we sold goods to Nidhi, and now we are receiving cash from Nidhi. Here the two accounts affected are cash account and Nidhi's account. Cash account is real account, and cash comes in the business, so it is debit. And Nidhi's account, Nidhi is person, so it is personal account. And Nidhi is the giver of cash, so it is credit. Let's see how we'll record it. 8th April, cash account debit 14,000 rupees on the debit side, to Nidhi's account 14,000 rupees on the credit side, and the narration is being cash received from Nidhi. Next. 10th April, purchased goods on credit from Ritu 20,000 rupees. Here the two accounts affected are purchase account and Ritu's account. Purchase account, it is nominal account, and purchase is expenses, so it is debit. Ritu's account, Ritu is person, so it is personal account, and Ritu is the giver, so it is credit. Let's see how we'll record it. 10th April, purchase account debit 20,000 rupees on the debit side, to Ritu's account 20,000 rupees on the credit side, and the narration is being purchased goods on credit. Next. 14th April, insurance premium paid by check 6,000 rupees. Here the two accounts affected are insurance premium account and bank account. Because we have paid by check, so bank account. Insurance premium account, it is nominal account because insurance premium is expenses, so it is debited. And bank account is real account, and cash goes out of the bank, so it is credit. Let's see how we'll record it. 14th April, insurance premium account debit 6,000 rupees, to bank account 6,000 rupees, and the narration is being paid insurance premium by check. Next. 18th April, paid rent 2000 rupees. Here the two accounts affected are rent account and cash account. Rent account is nominal account and rent is expenses, so it is debit. And cash account is real account and cash goes out of the business, so it is credit. Let's see how we'll record it. 18th April, rent account debit 2000 rupees on the debit side and to cash account 2000 rupees on the credit side. And the narration is being paid rent. Next. 20th April, goods given as charity 1500. You gave goods free of cost for charity. That means these goods are no longer available for sale, so your purchases are reduced. Here the two accounts affected are charity account and purchase account. Why purchase account? When you buy goods, you debit the purchase account because it is expenses. But when those goods are not sold but given away, it means part of that expense is not for business use anymore. So we reduce the purchase amount by crediting the purchase account. See, whenever goods go out but not sold, like charity, drawing, or samples, you credit purchase account because goods are decreasing. In short, purchase account decreases. Okay. Okay. Here, two accounts affected are charity account and purchase account. Charity account, it is nominal account because charity is an expense. So, debit all expenses. And purchase account is nominal account and it is an expense. So, it is credited. Let's see how we'll record it. 20th April, charity account debit 1500 to purchase account 1500. Narration, being goods given as charity. Next. 24th April, purchased office furniture for cash 11,200. Here the two accounts affected are furniture account and cash account. Furniture account is real account and furniture comes in the business, so it is debited. And cash account is also real account and cash goes out of the business, so it is credited. Let's see how we'll record it. 24th April, furniture account debit 11,200 to cash account 11,200 and the narration is being purchased office furniture. Next. 29th April, cash withdrawn for personal use, rupees 5,000. Here the two accounts affected are drawings account and cash account. Drawings account is personal account and owner is the receiver, so it is debit. And cash account is real account and cash goes out of the business, so it is credit. Here the owner has withdrawn cash. If it was goods withdrawn, then we would take it as purchases. Just because the owner has withdrawn cash, we are taking it as cash account. Let's see how we'll record it. 29th April, drawings account debit 5,000 rupees in the debit side and to cash account credit side 5,000 rupees. And the narration is being withdrawn cash from the business for personal use of proprietor. Next. 30th April, interest received in cash 1200. Here the two accounts affected are cash account and interest account. Cash account is real account and cash comes in the business because it is income. So cash comes in the business, so it is debit. And interest account is nominal account and interest we have received, so it is income, so it is credit. Let's see how we'll record it. 30th April, cash account debit 1200 to interest income account 1200 and the narration is being interest received. Next. 30th April, cash sales 2300. Here the two accounts affected are cash account and sales account. Previously, we have seen the transactions of credit sales, but here it is mentioned that we have sold the goods and we have received cash. So, cash sales. If nothing was mentioned, we would take it as credit. So it is mentioned cash sales 2300. So the two accounts affected are cash account and sales account. Cash account is real account and cash comes in the business. So it is debited. And sales account is nominal account. And after sales, we will receive cash. So it is income. Sales is income. So sales is credited. Let's see how we'll record it. 30th April, cash account debit 2300 to sales account 2300 and the narration is being sold goods for cash. Next, 30th April, commission paid by check 3000 rupees. Here the two accounts affected are commission account and bank account because it is paid by check. So, commission account is nominal account and commission is an expense. So, debit all expenses and losses. And bank account is real account and cash goes out of the bank. So, credit what goes out. Let's see how we'll record it. 30th April, commission account debit 3000 rupees on the debit side to bank account 3000 rupees on the credit side. And the narration is being paid commission by check. 30th April, telephone bill paid by check 2000 rupees. Here the two accounts affected are telephone expenses account and bank account because it is paid by check. Telephone expenses, it is nominal account because it is expenses and debit all expenses and losses. And bank account is real account and cash goes out of the bank, so it is credited. Let's see how we'll record it. 30th April, telephone expense account debit 2000 rupees on the debit side to bank account 2000 rupees on the credit side. And the narration is being paid telephone bill by check. 30th April, paid salary in cash 12,000 rupees. Here the two accounts affected are salary account and cash account. Salary account is nominal account and paying salary is an expenses, so it is debit. And cash account is real account and cash goes out of the business, so it is credited. Let's see how we'll record it. 30th April, salary account debit 12,000 rupees on the debit side to cash account 12,000 rupees on the credit side. And the narration is being paid salary. Now we have recorded all the transactions. Let's calculate the total. So it is 3,49,400 on each side. As you can see, the total of debit side and the credit side is the same, 3,49,400 each. That's how we know our journal entries are correctly recorded. In every journal, total debits must always be equal to total credits because for every debit there is an equal credit. If both sides match, it means all transactions are balanced correctly and recorded without mathematical errors. If your debit and credit totals don't match, that means there is a mistake in one of the entries. Maybe the amount, account, or posting is wrong. Always double check when the totals don't agree. That completes journal entries for Mr. Ram's transaction for April 2025. Notice every transaction follows the same logic. Identify the accounts, classify them, and then apply the debit and credit rule. If you found this video helpful, do like, share, and subscribe to Accountant's Desk for more accounting tutorials. And comment below which topic do you want to learn in the next video. And if you are a small business owner in need of bookkeeping services, just fill out the Google form linked in the description and we will reach out to you. Thank you for watching.